Well, good day. Scutty here, APAC market analyst at City Index, and what a week it's been. Started Monday, of course, following that pretty weak non-farm payrolls report in the United States, and it looked like Armageddon. I saw some carry trade unwinds involving dollar yen and other yen crosses. The movement in the Nikkei, that was equal to almost anything that I saw during my time on the desk during the GFC. So it's been a remarkable week, and to sit here now in the relative calm, I can't give you any confidence that I think it's actually over at this point in time. Now, I'll go through the details as to why that's the case, looking at some of the data releases, some of the factors behind what we're seeing this week, and then go and look at what we're looking at the week ahead, the key events to go and focus on, the influence in particular that short-end US interest rates are having when it comes to the markets at the moment, really influential in that space. And then I'll finish off having a look at some of the weekly timeframes across the FX and futures space, just to get a sense, not so much for trade ideas, but potentially when it comes to positioning and when it comes to directional risk over the short and medium term. Without any ado, this meme that I put up earlier today didn't get a lot of attention, mind you, so a bit disappointing there. So if you see it across your screen, make sure you give it a like or a retweet or something, whatever they call it nowadays. But this meme pretty much sums up the entire week, in my opinion. So we opened Monday, the whole world thought like we were completely and utterly going to go and have Armageddon. That's what it felt like. And then we saw that US ISM services number come out and a little bit stronger than expected. And that helped to go and alleviate some of those concerns. And then, of course, last night we saw the jobless claims data down 16,000 week on week, a little bit better than what was expected as well. And this huge relief rally take place across markets. Now, I wish I could go and say that I've got a lot of confidence in those two releases, but this is why I don't. Have a quick look here at these next slides on your screen. Hopefully I can go and get it up. There we go. So this is looking at just the monthly reading of the ISM Services headline PMI print. And just have a look towards the end there at how volatile it is. We saw a 51.2 outcome, I think, for July, and the markets rejoiced on it. But look where it came from. Look where we were in June, up much higher. And then again, we're back below 50, 49.9 the month before that. So it's incredibly volatile. So I wouldn't want to go and read too much into this particular data release because certainly it's volatile at the best of times. And really, you can't go and put too much weight in it, in my opinion. Same when it comes to initial jobless claims. So this is the percentage change in initial jobless claimants. So the first time claimants are looking for unemployment benefits across the 50 states and territories in the States. And you can see here just how wild the price action has been when it comes to the movements on a week-to-week basis. We saw a big drop last week, that followed a big rise the week before, which followed a big drop the week before, which followed an even bigger rise the week before, and then even a massive decline in the week before that. So it's up and down like a yo-yo, and so you can't go and put any real credence on this data, yet that's what the markets have underpinned on. That's what helped to contribute to that 3% rally in NASDAQ futures overnight. I know a more than 2% gain in the S&P 500. So it's really interesting how much the markets have hung on these two data releases, because it's been a really interesting week in that we've seen almost nothing else out there whatsoever. So these have been the ones that we focus on. Now, do we think it's over based off what we've seen with these two data releases? Well, the answer is no. And to go and sort of gauge where the temperature is at when it comes to markets and how they're seeing it right now, and certainly how I feel about it right now as well, is I'm looking at US 2-year Treasury note yields, because that gives you a sense as to where the markets see the Fed at and the outlook for interest rates and where the sentiment towards the US economy is here and now. So you can see here, it's just been one-way traffic and then really rolling over the 2-year yield. And you can see here, this is the payrolls figure last Friday, and it's Armageddon to go and close out the week, and then dropping down to 3.7%. So we've got a more than 40 basis point decline in 2-year yields over the space of just over a session, which is massive in the scheme of things. You rarely see moves like that outside of crisis periods. Now, we've managed to go and snap back on the back of that data, but you can see here, even now today, there's not a lot of impetus to go and drive futures, drive your 2-year yields higher. And there's still a lot of demand for 2-year notes here, clearly, sitting still just above 4%. So does the market, based on what 2-year yields are doing right now, suggest that the worst is over? That we are now going to go on a rip-roaring risk rally from here? 2-year yields are saying no, in my opinion. So keep that in mind when you're starting to evaluate what to go and look at in the week ahead. Just to go and reinforce that point, I want to have a look at the Fed Fund futures curve here. And this is between June of this year and June of next year. So basically still, excuse me, a 1-year look ahead here when it comes to Fed rate cut expectations. Markets still have 177 basis points of cuts priced in. That's huge. So that's not really fitting to me like being a soft economic landing. That's still the market's telling me that they think there's a decent chance that maybe we're looking at something a little bit more sinister at this point. And so when you put what's going on with 2-year yields, when you look at what's going on with the Fed funds curve, when you look at the flimsiness of the data that came out this week, the rally we saw overnight doesn't look to be on very strong footing. So any risk that you're going to add to, I know, this weekend or over the next week, make sure that you have your risk management is spot on in that front, because things can go and turn pretty radically at this point in time. It's still going to be pretty volatile out there at this point. Now, I focus on 2-year yields for a reason, and I hate to bang on about it. I'm sure that people who have seen my videos that I've released during the week would already know, but it's pretty clear that 2-year yields are so influential right now. It's essentially all one trade across every asset class. Now, what do I mean by that? Well, have a quick look here. So this is on a daily basis, the correlation between 2-year Treasury note yields up the top here, and just a variety of different financial market indicators below. Now, take a quick look at what's going on here. So this is 1 year ahead Fed funds rate cut expectations, correlation of 0.99 over the past fortnight on a daily basis. So nearly ultimately in lockstep with one another. But then look down further, 0.8 with Bitcoin, 0.81 with S&P 500 futures, 0.95 with dollar yen, and 0.82 with the Nikkei. So that's why I'm focusing so much on 2-year yields, because the perception about how the US economic trajectory is faring is being played out by markets, in my opinion, by what's going on in the front end of the curve. And to me, that's the area you should be focusing on in the week ahead, because that is going to go and give you your signal for all the risk trades out there at the moment. It really comes across as being that really influential thing. And whilst you can see from the correlation analysis here that I know there's been large chunks of time where there's been not a care in the world about what the front end of the US curve is doing, right now, that is what the central point is. So that's what you need to go and look at when filtering trade ideas in the week ahead. So what's coming up in the week ahead? Well, I'm glad you asked, because unlike last week and this week we're in now, we've got a lot to go and digest. And it kicks off really in earnest on Tuesday. All these times you can see on your screen as well are for Australian Eastern Standard Time at this point in time in Sydney. So you can see here on Tuesday, producer price inflation in the States. Now, not traditionally the biggest market mover when it comes to events over the course of a month. That's coming 24 hours later with the CPI. And the thing to remember with PPI as well, a couple of things, is we've seen recently that PPI readings in other parts of the world have typically gone and beaten expectations and picked up. So keep that in mind. The markets are looking for only a 0.1% increase in that PPI. You want to look at the core final demand as well. That will be one of the building blocks that you'll go and see that will feed into PCE, which is the Fed's preferred inflation measure later on in the month. And PPI doesn't always give you the same directional clues as to what CPI will print. So whilst they'll get a lot of attention on Tuesday when PPI comes out, it's the CPI report that's going to likely go and drive the bigger market reaction. And don't bet your bottom dollar that'll be in the same direction as what the PPI went and did 24 hours earlier. So that's my little 2 cents on that particular space. Now, when it comes to those inflation prints in particular, on this economic trajectory story and market angst about a recession, what we want to see is no re-acceleration in inflation, because of course that takes the prospect of rate cuts, large scale rate cuts and everything else potentially off the table in the near term. But at the same direction, if you see the PPI and the CPI coming incredibly weak, that will go and only help to go and fan fears that we're seeing a slowdown, and that's really been replicating what's going on in the price scenario. So what we want to see is a nice, slow, disinflationary path for these readings. That will be the ultimate outcome for risk. If it's too hot, that's problematic. And more so at the moment, given angst about the economic trajectory. If it's too cold, look out, because that will go and get people concerned about having to see the Fed slash rates, and it will go and raise question marks about what's going on in the real economy. On that front, retail sales on Thursday is the big release for me. Largest part of the US economy by miles when it comes to consumption. Retail sales is a fair chunk of that, not quite 50%, but close. So that's really important. Also get industrial production and jobless claims on that day as well. So that to me is going to be one of those really key moments to go and focus on. These ones down here, built-in permits and their Michigan consumer sentiment, I don't think they're going to be as strong as what this particular read is going to be. So keep a close eye on that Thursday in particular. To go and finish off, I just want to go and have a look at some of the weekly charts at the moment to go and get a sense as to where we're at when it comes to directional risk for these currencies. Also when it comes to some of the stock futures out there as well. Now, I know everyone doesn't really like weeklies. You can't go and get a lot of trade ideas if you want to go and do it on a shorter time frame, but to me it tells you a really strong story. So I'll just go across some of the ones out here right now, and hopefully that will go and put some meat on the bones. Aussie dollar, you can see this uptrend being running for a long time. Indeed, it's been running back since the start of the pandemic. And you can see here, bounced off it late last year, again, broke through and then snapped straight back again. And the price signal from this candle here on the weekly for me is really important. One way or another, unless we see a big reversal into the close, it looks like we're going to go and have some kind of hammer candle on the weekly. And you can see here, it's gone straight back above that trend line, and even managed to go and take out this area here that may have acted as support in the past. You can see here, that to me is suggesting that potentially, if risk appetite holds up, we could go and see a push back towards 67.15 or so. If it doesn't, well, we're back towards that uptrend again and testing that again. So to me, risk appetite, that's kind of your two levels for the week ahead. Looking at Kiwi. Now, RBNZ is out next week. Looking at some of the details, we saw a stronger than expected jobs report on the headline basis this week. But I've got to say, digging into the detail, it was pretty alarming. You wouldn't want to be a young Kiwi at this point in time. Big problems with youth unemployment. And also not a lot of growth in full-time jobs. And when you look at what's going on with the inflation expectations that came out from the RBNZ yesterday, it tells me that they're likely to go and start cutting come Wednesday next week. From the price signals from the chart, you can see here, again, actually in a symmetrical triangle at this point in time, and you can see here that when it broke out, tested it, and then bounced back up, again called, and then it looked like we're going to see a big bearish breakout here. Yeah, bear trap. And you can see here, this rebound today, unless we go and see the price going close back below that uptrend, that means to me that we're potentially going to look for another potential move back up into high territory. So keep a close eye on that in the coming week. When it comes to Euro, this explains about a lot what's going on at the moment in markets. You can see here that it too is in a symmetrical triangle. It's been calling up for a long period of time. And you can see here, it looked like earlier this week, big breakout. But the price signal right now, inverted hammer at this point in time, or you want to call it a tombstone doji, depends how it finishes up, of course, we haven't seen the end. That to me is telling me that more than likely, unless we see a reversal back over here over the course of the remainder of the session, there's not a lot of data out to go and suggest that that's going to be the case. Maybe we sink back lower over the course of the week ahead. So that to me, from a directional signal, is telling me that it's more likely that we'll see some downside rather than upside right now. Let's have a look at yen. What a ride we're seeing this week. Yeah, this is the kind of stuff that you saw back in the GFC. So I'm just shaking my head here. If you could go and see me now. Look, bullish hammer at this stage for the weekly chart, and it's been an impressive recovery off the lows, but it still hasn't got back towards that Jan 2023 uptrend. So it's a counter trend rally for me at this point in time, unless we manage to go and push back above. But you can see here, it's got above that 146.5 level there. And if it manages to close there, well, who knows? Just the price signal alone suggests that we might go and see a retest of this uptrend in the week ahead. And then look at the correlation, of course, that you can see between what goes on with dollar yen and 2-year yields in the States. That will go and determine things. Indeed, let's have a quick look at that actually really quickly. Red line here is dollar yen. And you can see blue line here is the US 2-year yield. This is a 1-minute tick basis, so getting real intricate. And you can just see, don't need the correlation analysis to go and just look visually how much it's been influenced over the course of this week. So to me, yeah, looking at this particular chart, as long as it stays around here, but particularly if it holds 146.5, that's a pretty bullish signal, and then we'll see what happens early in the week. Will it be able to go and bust back through here? Will this be a fade out for bears, and will we go and see a return to norm? Well, let's go and see what the data says in the 2-year yields in particular. Gold, yeah, it's in an uptrend at the moment. Not the prettiest of ones, it's got to be said. But just looking, it keeps bouncing up, and you're seeing here, every time it's gone and touched that uptrend, I should say, it's managed to go and bounce. So to me, the way things are going at the moment, the way things are going for the US dollar in particular, we'll actually look to it in a second as well, and where yields are, you can imagine that what's happening right now, if we see a scenario where it's not so alarming that we see a real ugly sell-off in markets, but we do see a bit of softness in the US dollar come through, and potentially, yields stay at these levels or drift lower, there's every likelihood that we'll see gold go and take out the former highs. It's just, it's been a relentless move over the course of the recent years, and I don't see a reason why it wouldn't. If it managed to go and get here with the dollar strong and yields at multi-decade highs, well, what's it going to do when those two headwinds go and flip around? You'd imagine that it should be pretty bullish at that point. On the US dollar index, it too has been calling in a triangle. You can see here. But right now, as things stand, look, at this point, it looks like it's a dragonfly doji on the weekly. And you can see here, bounced directly off that uptrend. Also, 102.31, you can see here, it's bounced off that level a couple of times earlier in the year. So the price signal, and this is predominantly coming through from what we've seen in the yen and the euro, and a bit of softness there later in the week, suggests that we might go and see some upside. But are we going to get through 104? Maybe. And are we going to go back towards the upper limb? Well, that's going to have to go and change a real distinct shift when it comes to interest rate expectations from the Fed. Is that likely? I don't think so, in short. Bitcoin. I wrote about this earlier today, so don't shoot me. I don't usually go and talk about it. But yeah, pretty obvious flag pattern to me, and it's been bouncing off it, trying to break through, but hasn't. And then look at the rebound we've seen this week. At this point, it looks like a bullish pin on the weekly time frame. And the thing I like about Bitcoin is that whilst it is influenced by risk assets, and that has been seen this week, it really is clean when it comes to the messaging from the patterns. A lot of the time, they're really reliable price signals. So most recently, you can see here, bearish engulfing, Morning Star. You can see here, Evening Star, bearish engulfing. So to me, a lot of the price signals you can go and trust. Now, this big move we're seeing here, I know a few people might be reluctant to go and chase it, but I just like the look of it. If it was to go and say close the week above 60,000, that's still giving me a pretty bullish signal on the weekly chart. And then you can see here early in the year, found some buying there. There were some times where it dropped further below, but also it stalled there at one point on one of the weeklies a couple of weeks ago. So to me, if it does, if you want to contemplate a long and we get a bullish price signal, who knows? Maybe up to the top of the flag. And then if it takes out this 70,000, you can see lower low, lower low, lower low. Sorry, lower high, should I say. If this goes and takes out 70,000, well then, YOLO, we could be off to the moon. So we'll see what happens. But certainly the price signal this week, just the turnaround has been really, really dramatic. And that's something that I like at this point in time. Tell you really quickly, I know we're about to go and tick over time here, but just from a price signal, thought it'd be nice to go and have a look. Start off with the ASX. I would encourage you to go to the City Index website and also have a look at what Matt Simpson, my colleague, has been writing about earlier today. He's got a technical piece up there about SPY as well. You can see here, SPY's broken the uptrend that it was in, and we only hit record highs not that long ago, and you can see that big bearish pin probably set the scene for what we saw over the course of this week. It's been an impressive fight back. You can see here, below 7,500 in SPY has got lots and lots of bids over the course of this year. So it's not really ready to go and give up on potential upside when it comes to the index, but we have to go and see where it closes this week. It'd be really, really unlikely for me to go and see it close back above this. If it did, that's an incredibly bullish signal in itself. But as things stand right now, maybe instead of being in an uptrend, we go into a more sideways range trend. And we know that we've got big corporate earnings coming up next week as well. And we know that we've got a lot of risk events to go navigate in the States. So who knows, maybe instead of what we're doing here and talking about going up, maybe we just go and range sideways for a bit of time. Nikkei. Nikkei is basically the same thing as dollar yen. Essentially, there's not much more to say about that. And yeah, bullish pin at this point, hasn't closed today, but no, what an impressive rebound off the lows. One thing I've got to say about this, if you look at the daily time frame, the volumes that have accompanied the rebound here have not been overly impressive. It was lots of selling to begin with, and then the rebound has been progressively lower volumes each day. So that to me is just one little warning sign. Potentially again, if we don't reclaim this 2023 uptrend, this is a counter trend rally, a big one at that. But no, the price signal alone, as long as it stays around this kind of levels into the close, who knows? It looks like that will be tested, that uptrend again at some point in the near future. You can see 36,985 as well has been a level the price has done a lot of work either side around over the course of the earlier parts of this year. So keep that in mind as well. Bullish signal, but yeah, do I trust it at this point? I want to go and see what happens next week, to be honest. Let's finish off looking at US futures really, really quickly as well. S&P 500, again, bullish hammer, bullish pin, take your pick there, but really impressive rebound. It's broken the uptrend running back to October of last year, and that of course is when the Fed pivoted away from rate hikes towards signaling being on hold and then eventually signaling cuts. But just the other price action here, we'll see how it finishes tonight. But the fact you can see here that it looks like it might go and close above 5333, where you can see the price had been capped for quite a few times earlier this year, and then retested and bounced off it, and then stopped dead on the sell-off that we saw over the course of late last week. That to me is a really important level. So if we close above there, the price signal means we might go and push higher again next week and potentially back towards that uptrend. So that to me is giving me a pretty bullish signal at this stage. But again, take a close look at that data that comes out in twos, because that's going to be influential on what happens here. Just to finish off, NASDAQ, yeah, biggest gain that we've seen in a long time. And this one makes plenty of sense when you look at it from a technical perspective. Bullish hammer at this stage, you see how it closes the week, of course. But it broke this uptrend from October of last year, the Fed pivot, but it held the one back from the start of 2023 and just bounced off it really, really nicely. And to me, that's a pretty nice signal. So again, as long as it presumably holds around here into the close this weekend, we'll see what happens. It might go and retest this former uptrend. If it manages to break through 19,700, it breaks through that, well, we're back to the races. In terms of earnings reports, we're seeing most of the Mag 7 names out, and we're not going to go and see NVIDIA for another couple of weeks. So it's going to be, again, driven by sentiment towards the US economy. So those really, really key CPI and PPI prints earlier in the week will set the tone, and then we'll see whether the US consumer is still intact. Look, I know there's still a few people watching out there at the moment. So what I'll do, I'm going to put up the disclaimer. Feel free to go and put any messages through or any questions that you may have. And whilst you're reading the disclaimer, I did get a question on Twitter earlier today, just asking my thoughts about how the markets are paying so much attention to the payrolls data, and in particular, how flaky the payrolls data has been over the course of this year, with lots of downward revisions to prior data in particular. My thoughts are that, well, it is flaky to begin with. It's not giving you a very reliable signal. And when it comes to the Fed, in my view, the Fed is not so much interested in what's going on with payrolls growth month to month. It's more interested in the inflationary aspects of the labour market. So what I think it's paying much more attention to is what's going on with the unemployment rate. And we knew that it went and increased by 0.2% in July. So that probably explains some of the anxiety that we saw in the markets and why there was a lot of talk about recession and everything else, because typically at the start of recessions, we do see unemployment start to go and rise pretty quickly. Also, underemployment, U6 in the United States is another measure that feeds through when it comes to wage pressure. So to me, those two numbers are far more important to the Fed than payrolls. Unfortunately though, payrolls is really, really influential on the initial reaction to markets. But of course, if you see payrolls going to do something really spectacular and then unemployment continues to go and rise, well, that gives you an opportunity to go fade in that particular area. I can't see any questions coming through. Look, I'm sure that a lot of you are probably pretty exhausted after the week that's been. It has been an incredible week that we've had to go and deal with as traders. But yeah, look, next week it's going to be pretty whippy again. So risk management will remain a very, very key part of any trading setup. And again, CPI, PPI, and retail sales in particular are going to be those real key events that are likely to go and move two-year yields, sentiment about the US economy, and also be really influential on risk assets. Have a fantastic weekend, and I'll catch you next week. Thanks for your time.